Yes, I know. Facebook is currently up more than 100% from its recent lows of $88 per share. Can you believe that? However you spin the argument, I would just like to give 2 thumbs up to those who actually held onto your Facebook conviction. So haven't been easy, been there, done that. Post Q4 earnings release, I actually tweeted out a congratulatory message to Meta backholders, while also outlining my own journey with Meta platforms thus far, where I diamond handed, but I failed to average down because I was probably suffering PTSD from people not smashing the like button. I just cannot comprehend and understand why would you not smash the like button. It comes at zero cost to you, but motivates the creator immensely. So remember to just do me this favor. So in this video, I'll briefly outline my thoughts on where I currently stand with Meta being in my portfolio, some updates on how I look at the current valuation, and what my game plan would be moving forward with this investment. So for those of you who want a proper breakdown of Meta's recent earnings numbers, I suggest you check out this video instead. So I know many investors actually turned bullish on Meta overnight because it does seem like as if it's the fundamentals that are tracking the stock price. But trust me, it's the stock price that actually tracks the fundamentals in the long run. So let's take a moment, forget about the price action of the stock, and look solely at the business alone. So I'll bring you back to a Substack article that I've written a few quarters back around my analysis of Facebook as a company, and it was published back in June of 2022. So shameless plug here, do join the email list on Substack if you're into things like this. I might write more articles in the future, who knows. Anyhow, just keep this timeline at the back of your head so you can be more appreciative of my assessment then. So back in June last year, we just had the Q1 results release, and many might argue that Q1 of 2022 was actually the peak before the impending earnings destruction, as we have seen that played out over the last 3 quarters. So this was what I claimed in the first paragraph of my analysis. For the most part, I largely disagree that this is the Yahoo moment for Facebook, and these short-term headwinds will not have a fundamental impact on the long-term value creation for Meta shareholders, although many seem to think otherwise. So by Yahoo moment, I was suggesting that it would be tough to make Meta irrelevant because relevancy is all that matters in the social media space. At least for now, based on commonly used metrics to evaluate this sort of businesses, like active users, time spent, downloads, Meta is still tightly gripping on the top spots and continues to grow despite all the skeptics out there. So that's fine for now. On the part of not having a fundamental impact to the business itself, let's talk about it. So initially, I've identified 5 curses of Meta platforms then, and let's see how they've developed throughout the course of 2022, in hindsight of course. Number 1, on regulatory risk. Not much have happened in that domain, even though Meta Platforms actually just received the approval by the courts on acquiring this company called Within Unlimited, the maker of a VR AR fitness app. So rest assured that the FTC will still be knocking on the doors of these different big tech companies in time to come. So I wouldn't necessarily say that Meta is definitely out of the woods in terms of big tech crackdown. Number 2, the $10 billion Apple problem. So in Q4 of 2021, Meta's CFO actually did forecast a revenue impact with iOS changes to cost Meta around $10 billion in 2022. So the full year of 2022, Meta's top-line revenue actually shrunk by around $1.3 billion. Shrunk, by the way. So how much was it affected by Apple's recent ATT policy? Who knows? Could the guidance be exaggerated to paint a picture of how Apple is essentially bullying Meta? Sure, but those are just narrative and storytelling. I want to see how Meta is adapting. So in the latest call transcript, Zuckerberg actually did mention that they're continuing to invest in artificial intelligence and they're seeing the efforts pay off here. So in the last quarter at least, advertisers actually saw over 20% more conversion rates than in the year before. So combined with a declining cost per acquisition, this has resulted in a higher returns on ad spend. And this is definitely good and ultimately bullish for the company's ad architecture. So this circles back to how confident you are with Mark Zuckerberg's reinventing the ad architecture post-privacy changes. So to me, I still choose to believe in the alien man. So I mean, come on, who doesn't? Number 3, on the TikTok competition, I've got some interesting updates. So it does seem like the engagement levels on TikTok has essentially started to plateau. So the total time spent on TikTok throughout 2022 actually went sideways. And in fact, Instagram is closing the gap up precipitously. Lastly, based on statistics from data.ai, TikTok is ranked number 2 in terms of total number of downloads in 2022. But Instagram is still the king of downloads. And Meta has 3 of the top 5 most downloaded apps in the entire world. Instagram, Facebook, and WhatsApp. They're not going anywhere anytime soon. More importantly, Reels that are being played across Facebook and Instagram have more than doubled over the last year, and it's Meta's direct response to TikTok as a competition. So those who think otherwise, please leave your arguments down below. So I don't want anecdotes, I want data. Number 4, the metaverse. So at this point, the metaverse is pretty much a joke. So in 2021, Reality Labs' operating loss was sitting at around $10.2 billion. In 2022, it ballooned to $13.6 billion. So despite the heavy R&D and capital expenditure, revenue for Reality Labs was down 5% year on year. What a project. Personally, I think how most investors look at Meta is relatively simple. So we know that Mark Zuckerberg has this pet project on the side that incinerates cash. Most investors probably don't give a F about that, but instead treat it as some sort of a call option. If it works, there's tremendous upside. If it doesn't, we're just going to write down the whole metaverse investment to zero. So at first glance, it does seem like a rather prudent way to evaluate Meta's current valuation. But I think a critical factor investors don't emphasize enough is the dude at the middle of everything, which is Mr. Mark himself. So Mark Zuckerberg in this case decides where to allocate the capital. So if he decides to screw with investors, we are on a sinking ship. So in my article, I did mention that I'm willing to give the team the benefit of the doubt, to exercise caution and be ready to pivot based on the historical track record. But one way to exercise caution as a retail shareholder is through position sizing. So Meta is definitely on the higher risk, higher reward category. Lastly, Meta's growth in a recessionary environment. So in retrospect, I'm not as concerned of a recession hitting Meta or any of these so-called cyclical companies for that matter, because we know that this too shall pass. However, in 2022, it was costs that went out of control, which had a detrimental impact of Meta's bottom line, even though revenue actually held relatively stable. So operating margins continues to slide down a cliff. Expenses balloon, capex only goes up. No wonder the share price only goes down. So to put everything together, at least in the recent earnings call, Mark Zuckerberg did attest to being more disciplined with the cost structure. He started guiding down expenses and capex in 2023 and has essentially pledged to buy back 10% of all outstanding shares, that is worth $40 billion. So these are all what Wall Street wants to hear, which essentially send the stock to the moon. So I must say, Mark Zuckerberg definitely knows how to play the Wall Street game. So I have then went back to revisit my initial valuation of Meta platforms. I've clearly committed the sin of modeling future expectations based on past performances, and 2022 was clearly a year of extravagance rather than a year of efficiency over at Meta. So cash from operations were down 12.5%, while capex was up 72%. Given that many investors are still expecting a slowdown in 2023, I've actually moderated the growth in cash flows out into 2026 downwards. And since Meta has guided capex in 2023 to be between 30 to 33 billion, I've also used the high end of the guidance in the name of conservatism. So my projection for 2023 in terms of the capex expenditure would be near to 33 billion. So applying a 15 times free cash flow multiple and a 15% discount rate, it actually feeds back a price of around $146. So this is by no means an indication of whether Meta is over or undervalued, but instead it's just a sense check on what are the expectations the market is trying to quote-unquote price into the business today. So the projections are purely based on the story I tell myself, so just take it with a pinch of salt. So at the end of the day, all market participants are just guessing, including myself. So my current game plan is rather simple. I'm not intending to chase this recovery on Meta, but if there is a retracement back downwards, whether is it because of a company-specific or market-wide issue, I might look to add, but I might actually demand a bigger margin of safety before adding. And with that, I'll see you in the next video, but more importantly, I will finally see you on the moon. Goodbye!